Today we're taking a deep dive into the fascinating and sometimes a pretty wild world of investing. We're guided by a really seminal work, Burton G. Malkiel's A Random Walk Down Wall Street. It's shaped how generations think about financial markets.
It really has. This book offers a truly comprehensive tour. It goes from the theoretical underpinnings of stock valuation all the way to the chaotic reality of speculative bubbles. And then importantly, it guides us towards a more sensible, evidence-based approach to building wealth.
Right. So our mission today is to unpack the core arguments, highlight some of the most surprising facts, and hopefully arm you with a fundamental understanding that can help you navigate this financial landscape. We'll explore what a random walk truly means, why some of the smartest people on Wall Street often, miss the mark, and what you, our curious learner, can actually do to invest successfully. Okay, so let's unpack these foundational theories of how we even begin to value investments. The first one, Malkiel calls it the firm foundation theory. This idea suggests that a stock's intrinsic value is based on the present value, or the discounted value, I guess, of its future dividends and earnings. Kind of like evaluating a business based on its actual assets and future cash flow, right?
Precisely. Yeah. Proponents like Benjamin Graham and David Dodd really champion this view, and its most famous disciple today is, arguably Warren Buffett. The challenge, though, is what Malkiel calls the slippery factor of future expectations. I mean, forecasting long-term growth for any company is incredibly difficult, which makes that firm foundation maybe a bit less solid than it sounds at first.
Which naturally brings us to the alternative view, the castle in the air theory. This one really dives into psychic values and the powerful influence of crowd behavior. It's less about what something is truly worth and more about what others perceive it to be worth.
Exactly. This perspective was brilliantly articulated by the economist John Maynard Keynes. He famously used this analogy of a newspaper beauty judging contest.
Oh, yeah, I remember that one.
Right. The goal isn't to pick the faces you personally find prettiest, but to predict which faces other people will think are popular. It's all about anticipating mass psychology, like what the crowd will chase next.
So if I'm getting this right, it's essentially the greater fool theory playing out, isn't it?
Huh?
You buy something that's already overpriced. Maybe you even know it, but you do it expecting that some even greater fool
will come along and buy it from you at an even higher price. That's exactly it. And, Nobel laureate Robert Shiller and psychologist Daniel Kahneman, they've significantly contributed to this behavioral perspective. They highlight just how much emotion and collective belief can drive market prices, often to irrational extremes, creating these beautiful castles in the air that just lack real substance. And that castle in the air theory has played out again and again throughout history, often, frankly, with devastating consequences. Let's look at some truly wild examples of market bubbles.
Okay, starting way back, 17th century, right? The infamous Tulip Mania in Holland. I mean, people became utterly obsessed with these infected bazaars tulips.
Yeah, the ones with the stripes.
Right, beautiful stripes. And their prices just soared to absolutely astronomical levels. What's one of the most incredible stories that shows the sheer irrationality?
Well, Malkiel recounts this amazing tale of a sailor. He sees what he thinks is an onion on a counter.
An onion.
Yeah. And he just eats this valuable Semper Augustus tulip bulb with his red herring breakfast. And he gets imprisoned for months for essentially consuming a small fortune. It's just such a vivid illustration of how a simple flower could become worth more than houses, completely detached from any, intrinsic value.
Yeah, it really does demonstrate extreme irrationality. And it's kind of unsettling how similar patterns just keep appearing in totally different eras. If we fast forward, just over a century to 18th century England, we find those same human behaviors playing out with the South Sea bubble.
Absolutely. The South Sea Company had this monopoly over trade to the South Seas, and the public's craving for new ventures, even completely absurd ones, was just insatiable. Promoters launched nearly 100 different projects, some as ridiculous as, importing jackasses or making boards from sawdust. This is actually where the term bubbles originated, because they popped so quickly, often within a week. Investors weren't scrutinizing feasibility at all. They were just buying into that greater fool theory, hoping to flip shares in the aftermarket.
It really seems like that greater fool mentality is just this consistent thread, isn't it? Okay, let's jump way ahead now to the 1929 stock market crash. This era was characterized by, quote, unrivaled prosperity. But underneath the surface, there was a lot of manipulation happening.
Oh, indeed. Investment pools were actively manipulating stock prices. They used managed news, discrete selling, all to rope in the public. It was a pretty clear example of insiders controlling information. For instance, Albert Wiggin, the head of Chase Bank, was notoriously caught short-selling his own bank's stock.
Wow.
And while Yale professor Irving Fisher was famously dismissing the market decline as just a shaking out of the lunatic fringe and declaring stocks had reached a permanently high plateau.
Yeah, famous last words.
Right. Roger Babson had actually warned, pretty presciently, weeks earlier that a crash is coming. But ultimately, it was a self-sustaining selling wave, triggered by margin calls that sealed the market's fate.
That kind of widespread manipulation and, frankly, denial, it truly highlights how even the experts can be blinded. It makes you wonder, how often are investors fooled by the illusion of innovation or complexity rather than, true substance?
That's a great question. And we saw this pattern repeat with phenomena like the Tronics boom of, 59 to 62?
Yeah.
And the conglomerate mania of the late 1960s. Companies would literally just add buzzwords like electronics or silicon to their names, or they'd sprinkle conversations with jargon like market matrices and core technology fulcrums, all just to dazzle Wall Street.
And it actually worked. Wall Street analysts often didn't understand the new language, but Malkiel says they got a nice warm feeling of being in the technological mainstream.
Yeah, this highlights a crucial insight, doesn't it? During periods of, irrational exuberance, the illusion of complexity, often veiled by sophisticated jargon, can be just as potent as a compelling story in swaying investment decisions, even among seasoned professionals. It's just astonishing how consistently these patterns repeat. And then came the Nifty 50 in the early 1970s. These were, the blue chip companies, IBM, Polaroid, Kodak. They reached these astronomical price-to-earnings multiples. Institutional managers started basically speculating in blue chips, completely ignoring the fundamental fact that no sizable company could possibly grow fast enough to justify an 80 or 90 times earnings multiple.
Yeah, that seems unsustainable.
Malkiel put it perfectly. Stupidity, well packaged, can sound like wisdom.
And sometimes it's not just a misguided valuation, it's outright fraud. Barry Minkows' ZZZ Best in the 1980s. That's just an incredible, albeit tragic, example of a charismatic leader deceiving absolutely everyone.
No, absolutely. Minkow built this whole rags to riches story, right? Appeared on Oprah, drove a Ferrari, all while supposedly turning a carpet cleaning business into this multi-million-dollar enterprise. But the truth, which came out when his bubble burst in '87, was that ZZZ Best was actually a sophisticated mob money laundering Ponzi scheme. It was built entirely on fictitious contracts and phony credit card charges. Just a complete house of cards.
What an outrageous story. It truly shows how charisma can just blind people to the most obvious red flags. Makes you wonder how many similar boy geniuses might be out there right now, building their own castles in the air.
Indeed. And it's not just individual companies. The entire Japanese stock market bubble in the 1980s serves as another really stark warning. The market increased, wait for it, 100-fold.
100 times.
100 times, with stock selling at over 60 times earnings. NTT Corporation alone, just the phone company, somehow exceeded the combined value of AT&T, IBM, Exxon, General Electric, and General Motors.
Wow. How did anyone justify that?
Oh, supporters found all sorts of justifications for these stratospheric valuations, but the financial laws of gravity, much like, Isaac Newton's apple, inevitably arrived in 1990. The Bank of Japan hiked interest rates, and the market collapsed by about 63%. A dramatic return to, typical price-to-book value relationships. It just underscores that fundamental value always asserts itself eventually.
That's a powerful lesson. And speaking of new paradigms, the early 2000s ushered in the explosive internet bubble. I remember vividly the Globe.com IPO in '98, soaring from $90 to $97 on its first day. With no revenues, no profits, it just felt like investors were throwing money at any business that simply had .com in its name.
It was a completely frenzied time. Wall Street's superstar security analysts, people like Mary Meeker, Henry Blodgett, they became public cheerleaders, earning multi-million-dollar salaries. But their incomes weren't based on analytical quality. They were based on steering lucrative investment banking business to their firms. This effectively blurred that Chinese wall, that ethical barrier meant to prevent conflicts of interest between research and investment banking, blurred it right into Swiss cheese.
Yeah, I remember that term. And this led to stocks being described as 4-baggers or 10-baggers, promising these huge returns. But the reality for many was, a proliferation of accounting frauds. From inflated asset values to companies literally lending money to customers just to book sales.
Or booking future lease revenue up front.
Right. Or Boo.com, that internet retailer, burned through $135 million in 2 years before going bankrupt. It was just a classic greater fool setup, but with a tech veneer.
And that illusion of complexity, that new paradigm idea, took an even greater toll with the U.S. housing bubble in the early 2000s. This had far greater significance for the average American because the entire banking system basically changed. The traditional originate and hold banking model, where banks made and held mortgages, shifted to originate and distribute. Mortgages were bundled into these tranches of mortgage-backed securities, the process Malkiel aptly calls financial alchemy.
So this new system created an incentive for incredibly loose lending standards, didn't it? Like no equity down,
Yeah.
no Zinja loans.
No income, no job, no assets.
Right, and no DOC loans where lenders didn't even ask for documentation. How did that amplify the bubble?
Exactly. This combination created this incredibly dangerous positive feedback loop. Rising prices encouraged more buying, more flipping of houses. Everyone was convinced prices would only go up. But of course, when prices eventually turned, the negative feedback loop kicked in, leading to a severe recession as debt exceeded home values, triggering foreclosures and a huge financial crisis. It just illustrates how new financial mechanisms can amplify old behavioral biases, leading to massive systemic risk.
And then more recently, we've seen the cryptocurrency bubble really epitomized by Bitcoin. I mean, it soared from pennies to almost $20,000 in late 2017, only to fluctuate wildly since then. Now, while it offers, seamless, anonymous transactions, avoids confiscation, what's its fundamental flaw as a conventional currency?
It's just extreme volatility. For something to function as traditional money, it needs to be a relatively stable store of value and a unit account. Bitcoin simply doesn't meet that criterion. And guess what? The name-changing phenomenon reappeared. Remember Long Island Iced Tea Corp?
Oh, yeah.
Their stock surged 289% after they simply changed their name to Long Blockchain Corp. It truly underscores that the underlying psychological drivers of bubbles seem to remain constant regardless of the asset involved.
It's amazing. So, okay, if markets can be so wildly irrational, how do professional investors even attempt to make sense of this chaos? Let's dive into their primary methods. First up, technical analysis, often just called charting. This is where technicians construct these elaborate charts of stock prices, volumes. They're looking for trends, resistance areas, support levels. They look for patterns, like a bear trap trying to predict future movements.
Right. And while it looks compelling, charting often fails to consistently beat the market. The problem is technicians tend to buy or sell too late. By the time a trend is clearly signaled on the chart, a lot of the move may have already happened. And, if too many people use the same charting strategy, it just becomes self-defeating as traders start anticipating the signals. It's a bit like that hot hand fallacy from basketball studies, where we mistakenly see patterns in random events, even when the underlying reality is purely random noise.
Okay, so moving on to fundamental analysis. The goal here is to predict future earnings and dividends to estimate a stock's intrinsic value. This sounds like a much more grounded approach, doesn't it?
It does, in theory. I mean, you have things like the rule of 72, which helps you understand compound growth, shows how quickly money doubles. But the catch is that companies, just like people, have life cycles. Sustaining incredibly high growth rates indefinitely just becomes harder and harder as they get larger. So forecasting long-term growth for individual companies is really fraught with difficulty and often relies on, heroic assumptions.
And relying on security analysts' forecasts adds another layer of challenge, right? I mean, unpredictable external events, regulatory rulings, new products from competitors, natural disasters.
Or devastating drug trial failures, like Celsion Corporation losing 90% of its value after a failed liver cancer drug trial.
Exactly. Those things make forecasting incredibly difficult.
And then there's the pervasive issue of accounting manipulations. Companies frequently stretch the rules to mislead investors. We've seen examples like companies swapping fiber optic capacity at exaggerated values or lending money to customers just to boost sales, only to have those accounts become uncollectible later.
Or booking future lease revenue up front.
Right, or pushing payments to suppliers into future years just to beat estimates and earn bonuses. It's this constant cat and mouse game.
That's pretty concerning. Yeah. And it gets worse, doesn't it? There's often a lack of understanding or objectivity from the analysts themselves. Malkiel tells this anecdote about an analyst named Louis.
Oh, yeah?
Who misplaces a decimal point in a copper price increase that would have made earnings jump by 10 cents, not $1. But he left it in the report because, quote, it sounded more convincing.
Unbelievable.
Or that study finding biotech analysts predicting market shares for competing artificial skin companies that added up to over 100% of the market. It really makes you question the expert label sometimes.
It certainly does. And furthermore, the very best analysts are often pulled into higher-paying, more prestigious roles in sales, portfolio management, or hedge funds. This just drains talent from the research side. And, as we touched upon earlier, significant conflicts of interest often exist. That Chinese wall between research and investment banking frequently breaks down. Analysts subtly steer lucrative investment banking business by promising favorable research coverage.
And the studies back this up.
Consistently. Studies show that strong buy recommendations from these firms often underperform the market, while firms without investment banking relationships often provide more objective and, frankly, better recommendations. So despite all these complex analyses and the best efforts of professionals, the evidence overwhelmingly shows that no one person or institution consistently knows more than the market. This brings us right to the efficient market hypothesis, EMH. It basically posits that all known information, everything from company financials to breaking news, even the collective biases of human behavior we've talked about, is already reflected in stock prices. Which means it's fundamentally impossible to consistently beat the market through either technical or fundamental analysis alone.
Okay, so the efficient market hypothesis suggests you can't beat the market. But what about the legendary investors we mentioned earlier, Graham, Lynch, Buffett, who did build fortunes picking stocks? Are they just incredibly lucky outliers, or does the EMH have some, blind spots?
That's a really critical point. And while these investors certainly found undervalued companies, especially earlier in their careers, many of them, including Buffett himself, have eventually endorsed the idea that for most investors, particularly today, they are better off simply investing in index funds.
Right. I heard Buffett even stipulated in his will.
Exactly. He stipulated that cash from his estate be invested solely in a low-cost S&P 500 index fund. That's a really powerful endorsement for the EMH's practical implications for the average person, wouldn't you say?
Definitely. So if consistently beating the market is so incredibly difficult, how do we invest smartly? The core principle, and it's really a non-negotiable one, is that risk and reward are directly related. Higher potential returns almost always come with higher risk, or volatility, which we often measure with standard deviation.
And that's precisely why diversification is so crucial. It dramatically reduces that unsystematic or company-specific risk. Think of it like this. If you invest in both an umbrella manufacturer and, say, a resort owner.
Okay.
In sunny seasons, the resort does well. In rainy seasons, the umbrella company does well. Now, while real-life assets aren't perfectly uncorrelated like that,
Wow.
a broad portfolio evens out those company-specific ups and downs. It reduces the impact if any one stock has terrible news.
And studies have shown there's a kind of golden number of about 50 U.S. stocks for significant risk reduction. But the benefits grow even more with international diversification, right?
Yeah.
Blending U.S. and, say, European or Asian stocks.
Absolutely. Because economies aren't perfectly synchronized, this offers greater benefits. We saw this during the lost decade of the 2000s when international diversification significantly helped U.S. investors whose domestic market was flat. And even safe bonds proved their worth as diversifiers during the 2008-09 financial crisis. They held up when stocks plummeted. Now, systematic risk, or beta, is the risk that cannot be diversified away. It measures a stock's sensitivity to overall market swings. The traditional model, the capital asset pricing model, or CAPM, predicted that higher beta should mean higher returns.
But then came those surprising findings from researchers like Fama and French in 1992, showing a largely flat relationship between beta and return. This led to people talking about the death of beta in the financial press. So if higher beta doesn't always mean higher returns, what good is it?
Well, beta still proves useful for predicting relative volatility. So a high beta stock will likely be more volatile than a low beta one, even if it doesn't guarantee a higher return over the long run. But the market is more complex than just one factor. That's where more advanced models like arbitrage pricing theory, APT, come in. Instead of just overall market sensitivity, APT considers multiple systematic risk factors, things like a company's size, its inherent value, or even its recent price momentum.
Okay.
It's basically a recognition that different kinds of risk can offer different kinds of returns, and understanding them helps build a more robust, diversified portfolio.
Right. So while these academic models often assume perfect rationality, human behavior, as we've seen time and again in those bubbles, often proves otherwise. The field of behavioral finance really dives deep into our quirks and cognitive biases, showing how they influence our financial decisions.
And one of the most prevalent is just overconfidence. Investors, particularly men it seems, tend to overestimate their skills and underestimate risks. This leads to excessive trading and, ironically, poorer results, as studies from Barber and Odine have shown. We simply aren't as good at setting accurate confidence intervals about our own abilities as as we think we are.
And then there's the illusion of control, where people see trends that don't actually exist, even in totally random data. It's like that computer ball experiment where subjects felt they had control over a randomly moving ball, even when their input device wasn't even connected. How does that play out in investing?
Well, it leads us to believe we can spot patterns in stock prices where none exist. It makes us think we can predict future movements from charts or news headlines, when often it's just random noise. And related to that is representativeness, where people mistakenly use similarity for probabilistic thinking. Remember the famous Linda experiment?
Vaguely.
Yeah.
Remind me.
People were told Linda is smart, outspoken, concerned with social justice, then asked if it's more likely she's a bank teller or a bank teller active in the feminist movement. Most pick the second, even though being just a bank teller is statistically more probable. We fall for a compelling story over actual probabilities.
Right. And herd behavior, that's another big one. And we saw it clearly throughout the bubbles section. Solomon Asch's conformity experiment showed how group pressure can literally change what people perceive. Malkiel notes that during the internet bubble, an unreasoning herd mentality and these positive feedback loops led investors to buy for no other reason than that prices were rising, creating a kind of Ponzi scheme. As Charles Kindleberger wisely said, there is nothing so disturbing to one's well-being and judgment as to see a friend get rich. What's the real-world penalty of this herd mentality for investors?
Well, this herd behavior often leads to what's called a timing penalty. Investors tend to pile into mutual funds right at market peaks and then sell in panic at market troughs, essentially doing the exact opposite of buy low, sell high. And there's also a selection penalty, where they chase recently hot-performing funds only to see those funds underperform later, often because their strong run has already peaked or the style is out of favor.
And perhaps the most impactful bias is loss aversion, pride, and regret. Kahneman and Tversky's prospect theory found that losses are felt far more intensely than equivalent gains are enjoyed. Like, a $1 loss is maybe 2.5 times as painful as a $1 gain is pleasurable. Wow, 2.5 times.
Yeah. And this leads directly to the disposition effect, where investors sell their winners too soon to lock in a gain and feel proud, and hold on to their losers way too long to avoid the pain of admitting a mistake and realizing the loss, which is financially suboptimal and often tax inefficient. How do we even begin to overcome such deeply ingrained tendencies like that?
That's the million-dollar question.
Well, this is seen in the housing market too. People hold on to homes at inflated asking prices rather than realizing a loss. But behavioral solutions do exist, like Thaler and Benartzi's Save More Tomorrow plan.
How does that work?
It cleverly commits employees to allocate a portion of future salary increases to savings. By tying savings to future raises, it removes that immediate pain of a reduction in take-home pay. It effectively overcomes loss aversion in saving decisions. Pretty smart.
That is clever. Okay, finally, let's talk about the limits to arbitrage. Even if rational arbitrageurs should theoretically correct mispricings in the market, they often face significant constraints in reality. For example, why did we see so many hedge funds during the internet bubble just ride the bubble rather than trying to short it and profit from its eventual collapse?
It's because the mispricing often grew even further due to contagious enthusiasm, and it's incredibly risky to fight a trend that feels unstoppable, even if you know it's irrational. You can go broke waiting for the market to become rational. There are also technical constraints on short selling. It can be difficult or expensive to borrow the specific stock you want to bet against. And sometimes there is simply no close substitutes for an asset, which prevents easy arbitrage.
Like what?
For instance, Royal Dutch Petroleum and Shell Transport, despite having identical underlying cash flows, have historically traded at different values for long periods, with Royal Dutch often at a premium to Shell. This just demonstrates that even identical assets can be mispriced for extended periods, limiting arbitrage opportunities. Okay, so understanding market dynamics and human psychology is crucial, but what do you actually do with all this information? Here's a practical guide, sort of like your investment fitness manual. Exercise 1. Gather the necessary supplies, which fundamentally means you must save first. Regularly saving and starting as early as possible is honestly the single most important factor for financial security, even more so than your investment returns, arguably.
Right. Got to have the fuel first. Exercise 2. Don't be caught empty-handed. That means building cash reserves and securing the right insurance. Buy low-premium renewable term life insurance for protection if you need it. And generally avoid those high-premium whole life or variable life policies. They're usually not great value. And variable annuities.
Ugh. Unless you're super wealthy and have already maxed out every other conceivable tax-deferred option, definitely avoid them. The fees are just notoriously high.
Got it. Exercise 3. Be competitive with your cash reserves. For short-term needs, sure, consider bank certificates of deposit, CDs for safety, and maybe a bit of yield, but just be aware of early withdrawal penalties and state and local taxes.
Treasury bills, T-bills, are an even safer option, though. They're exempt from state and local taxes and easily available directly from the government at www.treasurydirect.gov. Very straightforward.
Okay, exercise 4. Learn how to dodge the tax collector. This is absolutely critical for long-term wealth building, isn't it?
Huge. Tax-deferred accounts like traditional and Roth IRAs and employer-sponsored plans like 401ks. They offer a significant advantage for long-term savings because your money compounds without being taxed each year until much later, or sometimes never, like with a Roth.
And the compounding effect is massive.
It's huge, even with just a steady annual contribution over decades. And for college savings, 529 accounts are a smart choice. Just be sure to choose low-cost providers like Vanguard to avoid those high commissions some salespeople push. Okay, a really key step here is finding your personal sleeping point. This is that balance between eating well, so chasing higher returns, which means taking higher risk, and sleeping well, lower returns, but much lower risk.
How do you figure that out?
Well, your capacity for risk depends entirely on your total financial situation, your age, your income stability, your responsibilities. Malkiel uses this fun Monopoly player analogy. Are you a plunger, building hotels on Park Place right away? Or do you prefer the steady income from owning the orange Monopoly? That can give you some insight into your personal risk tolerance.
I like that. Okay, when it comes to specific investment vehicles to consider, real estate. Homeownership is generally advised for most people, and for broader exposure to commercial real estate investment trusts, or REITs, offer diversification, usually solid returns, and they often act as a pretty good inflation hedge.
Right. And for bonds, zero-coupon bonds can be useful if you have a specific future liability, like college tuition in 15 years, because they eliminate reinvestment risk. But taxable investors need to declare the phantom income each year, even though they don't receive cash.
Good point.
So for most investors, no-load bond funds, especially low-expense bond index funds, are highly recommended. Bond markets are also quite efficient, so active management rarely pays off after fees. And for folks in high tax brackets, tax-exempt municipal bonds are a great choice.
Now, critically, some investments to probably avoid. Collectibles.
Right.
Buy them because you love them, sure, but not for profit. They come with all these hidden costs, fakes, insurance, maintenance, and historically, their financial returns have actually been surprisingly low.
Yeah, Malkiel points out Leonardo da Vinci's Salvator Mundi painting sold for $450 million in 2017, but it only returned a paltry 1.35% annually from 1519 to 2018.
Wow, not exactly beating inflation there.
Not even close. Commodity futures, way too risky for non-professionals, forget it. And hedge funds, they come with incredibly high fees, often 2 and 20, and just have no proven record of consistent outperformance after those fees are taken out.
Didn't Warren Buffett make a famous bet about that?
He did. His famous winning $1 million bet against hedge funds outperforming a simple S&P 500 index fund over a decade. He won easily, proving the point that for most people, they simply aren't worth the exorbitant cost.
Okay, so let's recap some key investment principles Malkiel hammers home. First, risk and reward are related, always. Higher average returns only come with a substantial risk. Be crystal clear about what you're signing up for.
Second, dollar cost averaging. This just means investing fixed amounts of money regularly, say every month. It significantly reduces the risk of dumping all your money in right at a market peak. And it can even lead to better returns in volatile markets because you automatically buy more shares when prices are low and fewer when they're high.
Makes sense. And the third one?
Rebalancing. This involves systematically bringing your asset mix back to your target allocation. Say, you want 60% stocks and 40% bonds. If stocks soar and become 70% of your portfolio, you sell some stocks and buy bonds to get back to 60-40.
So you're selling high.
Exactly. And if stocks crash and become only 50%, you sell some bonds and buy stocks to get back to 60-40.
And buying low, automatically.
Automatically. You might do this at regular intervals, say annually. This disciplined approach not only reduces portfolio volatility, but can actually improve returns over time. It's maybe the closest thing we have to a built-in mechanism that forces you to buy low and sell high.
Okay, so after wading through all the theories, the bubbles, the analysis pitfalls, here's the core recommendation for most investors, right? The true cornerstone of Malkiel's advice, the index fund solution.
Absolutely.
Its advantages are clear and really powerful. Index funds regularly outperform the vast majority of active managers, primarily because their management fees are dramatically lower, somewhere near zero now, and they have much lower trading costs because they aren't constantly buying and selling.
Right. And total stock market index funds, like those tracking the Wilshire 5000 or Russell 3000, offer really broad U.S. diversification, including those dynamic small companies that active managers often miss. And please don't forget international diversification, especially into emerging markets. It can enhance returns and significantly reduce your overall portfolio risk over the long term. Exchange-traded funds, ETFs, are also excellent choices here. They're often even more tax-efficient than traditional index mutual funds and have remarkably low expenses.
And for those people who enjoy the game of investing but want to keep their core retirement savings safe, there's the core satellite approach, right?
Exactly. Index the core of your portfolio maybe 80 or 90% for reliable, low-cost growth.
Yeah.
And then if you must, use that extra satellite portion for more speculative bets, individual stocks, or whatever catches your fancy, knowing your main goals are covered. And building on that, some investors look into these smart beta strategies, these tilt portfolios towards specific factors that historically have shown some extra return, like value, company size, momentum, or quality.
How have those worked out?
Well, single-factor smart beta funds have had pretty spotty results, honestly. But multi-factor strategies, like those from firms like Dimensional Fund Advisors or research affiliates, might be more promising because they offer diversification among the factors themselves. But this is crucial. It's important to remember that any excess returns you might get from these strategies are likely just compensation for assuming extra, often kind of hidden, risk. They aren't a free lunch.
Right. And what about risk parity, a strategy pioneered by people like Ray Dalio at Bridgewater? How does that fit into this picture?
So risk parity aims to take advantage of the observation that low-risk assets, like low-beta stocks or safe bonds, sometimes offer higher risk-adjusted returns than theory might predict. The strategy often uses leverage on these lower-risk assets to increase the overall portfolio risk and return to a desired level.
So it's balancing risk, not just dollars.
Exactly. The idea is to balance the risk contributions across different asset classes, rather than just focusing on capital allocation. The goal is to potentially create a more resilient portfolio across different economic environments. It's more complex, though. Now, for those who absolutely insist on playing the game of individual stock picking with their speculative money, Malkiel offers a few rules to at least minimize risk and temper expectations. First, treat it like a full-time job. It requires serious dedication and constant research.
No kidding.
Second, never pay more than a reasonable, firm foundation of value. Avoid those crazy high price-to-earnings multiples that scream castle in the air. Third, maybe buy stocks with compelling stories that could build castles in the air, but make sure they still rest on a firm foundation of actual value.
So potential upside, but with a safety net.
Sort of. And fourth, trade as little as possible. Ride your winners, but be merciless with your losers. Sell them to capture the tax benefits. Even then, Malkiel reminds us, consistent superior performance is incredibly unlikely, and lady luck plays a huge role.
Yeah, that seems key. And finally, investment advisors. While automated services, robo-advisors like Schwab Intelligent Portfolios offer low-cost diversified portfolios and automatic rebalancing pretty easily. Traditional human advisors aren't always necessary, are they? Especially if you're disciplined and follow the sound advice laid out right here in a random walk down Wall Street. Wow. We've journeyed through a lot today. The complex world of finance, exploring everything from intrinsic value and crowd psychology to those crazy speculative bubbles and some really practical, actionable investment strategies.
Yeah, what truly stands out to me again and again is the timeless wisdom of understanding market efficiency and the profound, often very costly impact of our own human psychology. It's really not just about what you invest in, but how you manage your own biases and expectations along the way.
Absolutely. The path to long-term financial security probably isn't about finding some secret formula or a hot tip from your neighbor. It's really about discipline, broad diversification, truly understanding risk, and perhaps most importantly, knowing yourself, knowing your own behavioral tendencies and how to counter them.
The power of broad diversification, saving regularly, rebalancing annually, and embracing low-cost index funds as your core strategy. That remains the most robust, time-tested strategy for successful investing. It's not glamorous, but it works.
So what does this all mean for you, our curious learner? Well, it means you actually have the tools to do just as well as the experts, maybe even better, honestly, by sticking to a few simple yet incredibly powerful principles.
Which I think raises a really important question for everyone listening. In a world that's constantly seeking the next big thing in investing, whether it's a new technology or some obscure asset class, how will you distinguish between genuine innovation that offers real lasting value and just another beautiful but ultimately fragile castle in the air waiting to collapse?
Hmm, something to think about. Keep those questions coming, and remember, the journey to being well-informed is definitely a continuous one.